Hello and welcome to the Stock Planner channel. Today I want to talk about two stocks, Tesla and Ford, and which one is better for a small account. Tesla trades over $600 a share and Ford trades around $15 a share. Which one is better for a small account? Before we get started, the goal of this channel is to educate. It's to help you develop a repeatable method and be profitable. I'm no expert. You probably know more about trading than I do, but we can all learn from each other and share some ideas. To do that, you must like and subscribe. Again, educational channel. Don't take advice from this guy, but we can all learn and learn together. Let's get started. A small account is an account size of about $10,000. Everyone these days is talking about Tesla. It's the stock of the future. It had a phenomenal year. If you invested 1 year ago and had 100 shares, you would have made a lot of money. It's the leader of the pack for electric cars, and also its space program and its ability to launch, re-land booster rockets, and possibly put men on the moon and in Mars, men and women, of course, has made this a very visible company, a company that's perceived to be a company of the future. I agree. Elon Musk has turned out to be a very formidable leader. But at over $600 a share, is it a good investment for people that have a small account of $10,000? Well, if you're investing about $1,000 to $1,200 per trade, it'll allow you to get around 2 shares. Nice car. So how does the buy and hold strategy work out for this small account? If today you bought Tesla at $600 a share and it goes to its $800 a share after 1 year, which is definitely possible, and some people are predicting it to go to $1,000, this would give you a return of 25%. Warren Buffett does 20 to 25% in a good year. He hasn't done it consistently over the last 5 years. It's harder when you have billions of dollars. We're not having that problem. Most viewers from on this channel have a small account. Buy and hold. Buy it and hope the stock goes up. Nice car. Now, an indicator strategy is one where you try to predict the peaks and valleys and try to capture those trend changes, and you pick indicators that do it. This is a down, and it would have predicted that down pretty well. That's the MACD, and this is a RSI, stochastics. That would have done it too, and so would the RSI. So you pick indicators that will try to predict this. That's the job of a swing trader. And if you have a stock that you chose, this is Ford, that does those swings, you could use an indicator-based strategy. This is my bread and butter. I use it all the time, and I use these indicators all the time to go in and out of those trades. I'll explain a little bit more, but that will work. This strategy here can definitely be applied to Tesla and Ford. And lastly, we can use an option-based strategy where you can sell a put where you think it will stay above that put price, and if you do, you will get $52. This is Ford. Now this is FCX, but the same thing applies for Ford or any other. You're trying to pick and sell puts so that the price, if you think, especially if you think the price is going up, like in Tesla and Ford, you would sell a put, and most likely you can get to keep this premium, $52. And if you do it 12 times, you'll have $600 or $700 and never own the stock. Selling puts long, to go long, has a lot of advantages, and I'll explain them a little further. Starting out with tip ranks today and going to the crowd insights and looking at the tip ranks average portfolio and see which most popular, you'll see that Tesla is widely held by a lot of tip ranks users. So is NEO. Now NEO's another stock that you could actually replace Tesla with. It's not as expensive. It's very popular, but Tesla is trading at a very high premium, and a lot of people with small accounts can't afford it. looking at Telsa, currently at 678, and you could say that's $700. That's very expensive. And the average analyst price, according to TipRanks, is 608. That's down. They have a low of 67 and a high of 1,080. This is lower than it's currently trading at. You have 24 analysts covering this, and apparently there was somebody that doesn't like it, and there is some people that apparently love it. The average is indicating that it's not going to do as well this next 12 months versus the last 12 months. It's a hold. That's not all that hot. Remember these numbers though, 608 and 1,080 and 67. Still get an overall ranking of 7. Hedge fund activities increased. We like to see that. The technicals are not so hot. Fundamentals. And it had a high in January, and it's come down since then. So if you have bought in January, you've lost money. 883. You've lost a lot of money. If you have 100 shares, it's 20 grand. This is interesting. I didn't see this article before. Ford stock continues to rev up against. That's interesting. And this is the reason why Telsa had phenomenal growth. But Ford and GM are catching up. And Ford has an electric truck. That's fantastic. Now more than ever, Ford is making up for lost time, along with GM and Volkswagen. Yeah, I read an article on that a couple of days ago. Ford is concentrating on commercial vehicles and trucks. I think they'll do well. Ford, on the other hand, is selling for around $15 and could go up to $15.44. That's the average, and I believe that the high is more achievable, $18. These numbers I'm going to use later, and it's a moderate buy with a 6 on the ranking. That's a nice steady climb, and I think the trend is still going to be up, at least for the next year. Looking at Simply Wall Street, they have Tulsa as being 230% overvalued, and Ford as 38% undervalued. So the theory is that an undervalued stock will get discovered being undervalued, and then the price will increase because more people want to buy things that are a bargain rather than investing in things that are already overpriced. Looking at the chart though, look, up, down. That is a nice truck. 20% increase in value in the stock. We showed you that on the chart. They're saying that it could go as far as $22. TipRanks had 18. I think it is a $22 or a $25 stock. The health of the company is generally good, and it has good value. The stock has good value. And there's the growth, steady growth in the forward years, 2025. Not phenomenal, but steady growth. And if you remember, TipRanks had the stock price declining a little bit. Telsa's going to hit a wall where their advantage in EV vehicles will be eroded away by these big companies. So let's do a little number fingering up here. Okay, we got a trade size of about $1,000, $1,200, give or take. Our account is $5,000 plus $5,000 in margin. So we have around $10,000 to play with, but you never want to invest all $10,000 in one stock. You want to kind of spread it around, so that's why we use $1,000 per trade. This is a new spreadsheet, by the way. I'm going to do this for a couple more stocks where I'm comparing to a high price stock and a low price stock, and see if we can go ahead and take advantage of our small account in order to grow it to a large account. Now, these numbers here I just got from TipRanks, and you see that there's the $18 for Ford and $1,080 for Telsa. This is the hype stock. Everybody's talking about it. And Ford is kind of like the has-been. You could buy 1.5 shares of Telsa, and you could buy 67 shares of Ford. Based on this target price, if it's achieved, you would have invested today, you would have treated a 37% increase. That's better than Warren Buffett's doing, and you would have netted about $590. So $590 is a number that we need to remember. And likewise, if you achieved the maximum, $18, you would have achieved 205, which is about a 17%. That seems reasonable. So far, if you invested merely $1,000 in one or the other stocks, you would have done, and if it achieved the highest prediction, you would have done much better. If it achieves the mean, you would have lost money and you would have made a little money. I think both of these stocks are going to go up, but I'm not sure about $1,000 for TSLA. Now, the next thing I want to look at is an indicator-based strategy, and all we have to go on that is back testing from the last year in hopes that the future will achieve the same results. Looking at TradingView and looking at Ford on the daily time frame, each one of these little bars is the daily time frame, and going back to the beginning of the year, which is about 6 or 7 months, and looking for our strategy here for this test is basically an RSI strategy, and basically when the RSI 4 goes below the 30, you take a trade. And just looking at buys right at the moment, and maybe here, but okay. And that would have been a win here, maybe a win, but certainly if it didn't win here, it would have went over here in a couple more days later. And then here, maybe a win if you set your stop loss. Set your stop loss soon enough. So that's basically it for Ford. We'll actually do some back testing. I have an algorithm that actually does it automatically for us. TSLA. And basically it's a hot stock going up, up, up to the moon. So we're just going to look at the longs. And so that would have been a win here, a win here, a win there. That would have been a loss. And maybe we don't know. But I might not took that trade at earnings. Indicator, taking the trades when the indicator says. This is another charting package and testing tool, back testing tool. It's you can program it very easily. That's why I like it. And you can do back testing on a large amount of stocks or portfolio of stocks, which I like. Anyway, I've written an algorithm to go out and search for when the RSI comes back around. And I've set some constraints for a $10,000 account, and we'll run a back test from January 2020 to today. A little more than a year and a half. And TSLA gave us 6 trades, and the cumulative profit is about 187. We've had some losses there, max losses. Started out with 10,000 bucks, made a profit of 187. That's not good. That doesn't even take care of inflation. Need about 3%. The annual is slow. But here, you got to remember that you're in and out of the trades, so you don't have all your money invested for the whole year like your buy and hold. Buy and hold is buy a stock and you hold it for 1 year. Your money's used, tied up. Here, you're in and out. You've taken 6 trades. The average bar is about 3 days, and then you're out to make this money. And if you use it and look at the risk-adjusted return for those 3 days that you're in, that's phenomenal. And you got to remember, you can use this money and apply it somewhere else. So this is instead of looking at the APR, you would look at the risk adjusted. Very good. Your win rate is not so good, 3 winners and 3 losers, but you still manage to have some money. Taking this win rate in the days and the average bar held and taking it to our chart, we fill that in. And there's your $187 we mentioned, and there's your $288 risk adjusted APR. Which, if you looked at that, for the time you have your money in play versus this, 288 versus 37, this is the reason I'm a swing trader. But you didn't get as much money, 590, 187. Doing the same thing for Ford and running a back test using the exact same criteria, we end up with 343, which is more than we ended up with TSLA. Now remember, we're only... in this regards, we're only investing the same $1,000 per trade and ended up with a little more. And our win rate is a little better too. Risk adjusted is 142, which is lower. 143 is lower than the TSLA because the average bars that you were holding is 9 days, nearly 10. So you had your money in play, so your risk adjusted value, even though that the profit went up, the amount of days that you risked it caused this to come down. And here's our win rate 83%, 5 and 1. Transferring that data back over here. There's our 313 and your risk adjusted differences. Which one would you play? We like this one and we like this one. 17% and 37%. 283 versus that and 142 versus that. So far, I like these two because I like to have my money to use it for other uses. This is my bread and butter. I do this every single time. I look for these kind of situations, the peaks in value, get in and get out. That's what swing traders do. This is what you're supposed to be doing. Find those peaks and valleys, and then you try to find indicators that predict that stuff. It could be there's a million different indicators out there, lots of them on TradingView. This is a free package. The paid version, you get up to 5 indicators. Free one, you get 3. That's enough to start. But what if I had and gave myself a bigger advantage? What if I knew, based on my indicators, where these were and could place a trade about 10% below or at a discount, would make a bet that it wouldn't reach that point again for 20 to 30 days or 45 days. This would have been a winner. And likewise, if I was able to predict the top and put my trade there, saying that it wouldn't go above that for 21 days, I would have won that money too. Granted, it would be a smaller amount of money than if I actually owned the stock, but I won't have so much margin, won't be using so much margin, and can take these trades for, instead of $1,000, could trade these trades for $500. So I would only have to put up $500 to make a smaller amount, but I could do more of these plays. And if I could do this and make $50, $60, $70, $80 each time, I would make some money. But here's the problem. To do TSLA and make that bet here, you would get $52 times 100, because there's 100, you have to take 100 shares, and that would be what? $55,000 to make that bet that it wouldn't go up. You would get $5,000 every time you did it. $5,000. But you would need to put approximately half of $60,000, because that's what the stock is trading, $700 per share, and you need 100 shares, so you'd have to put one half of 60,000, at least $30,000 up in order to do this trade. To get your $5,000, you'd have to have at least $30,000. And you got a small account, so a small account cannot do this trade, but it could do the forward trade. So every time you see these majors, you place a trade a little bit below, hoping it won't hit, and they won't. You can do the same thing with the minors. Below, 2 weeks to 30 days, and hopefully don't hit. If it does hit, like maybe it hit there, you'd have to take possession of the trade. In other words, the stock would be put to you, and you'd have to buy it. But again, if it's only $1,500 per $100 for 100 shares, you can afford that $15 a share. So you can afford to have the stock put. And if you think it's going to go, if the stock is going to go up steadily to $18, even if you get the stock put there and hold it for a little while, you'll make your money back. So in our case, we'll be a believer that it's going to reach $18 or $20 or $25. We don't care if the stock is being put, but we would like to collect the premium. Now, it's not $52 like it is over in TSLA. It's 48 cents times 100, which equals $48. $48 every time you do one of these plays. If you do 12 of them a year, that's $600. $50 of it. That's about $600. That is sweet. And if you get the stock put to you a couple times, what do you care? Because the stock is going up to 18 or 20. So, and you only need around $500 to have to do these plays in margin. So you can do several of these with a small account, but you can't do it with a high flying stock like TSLA with a small account. But you can do these little option plays, and they're simple to do for a stock that you believe is going up. So you pick undervalued stocks that you believe are going to increase, and you can do this, sell and puts. And if you got the stock put to you, you can sell calls against that, cover calls against that. So I think this is a winner. I do it all the time, and it's a little simpler trade, and it's steady and repeatable. Every 2 or 3 weeks, I can do another play, and it's just wonderful. You're always getting, if you have to buy the stock, you're always buying the stock at a discount because you're always selling a put that's below the current price. So if the stock gets put, you at least got a dollar discount. Let's see how this looks on paper. Okay, we can't do this because we don't have enough money. But if you did, you would have got this. That's sweet. That's getting $5,000 doing 12 plays a year. $5,000. That's sweet. The margin is less than $700. You get around $50, which is if you did 12, it would be 46% increase. That's twice as good as Warren Buffett, and it would have netted you about $700. So I like this $700, and I like this percentage, and that percentage there beats this percentage and beats that, and that is Tesla with the highest dollar prediction. Slow and steady gets it. Now, granted, you have to do 12 plays here versus 1 up here. Smaller plays, and if you lose one, you won't lose so big as if you lose that one. And these aren't half bad either, but you can see why I like slow and steady. And you can see why I think Ford is the better deal based on the fact that I think the growth rate for Tesla is going to slow down. Do you agree with me? If you do, please leave a comment below. I hope this helped, this analysis helped. And I'm going to do a few more of these and smooth this thing out a little bit. I think Ford is the better deal. Again, remember, don't take advice from this guy, but collectively we can all learn together. Like and subscribe. This channel is getting better. My trading is getting better. Even my videos are getting better. You can buy the hyped up Tesla stock, or you can buy the slow, boring Ford stock. What is your choice? Happy trading. Catch you on this flip. Did I say like and subscribe? Please do. Thank you.